Subverting traditional finance. How can DeFi's high yield be achieved? In recent years, traditional banking business has become less and less popular. The annual interest rate of some bank savings accounts in the United States can even be as low as a ridiculous 0.1%. Considering that the current inflation in the United States is close to 5%, savings account equals loss of money. In the same period, the annual interest rate for deposits in Anchor Protocol was 20%. Anchor Protocol is based on the stable asset protocol Terra Money, which is a new type of savings protocol. Aims to balance interest rates by coordinating block rewards from multiple different POS blockchains. And finally achieve a stable yield of storage interest rates. I think anyone knows which one should be choose next. DeFi's rate of return seems to be high and unrealistic in many cases, which makes people have to be curious. How are these rates of return generated? Are they really sustainable, or are they just Ponzi schemes? Compared with other markets such as traditional finance, cryptocurrency has a high rate of return, which is also criticized by many skeptics. Unusually high rate of return equals Ponzi scheme. It seems that there is nothing wrong with the logic, but we still have to research and understand by ourselves. Doing due diligence is more important than anything else. The high income of DeFi is not only Degan can earn. DeFi may be known for its extremely high yields, even with relatively safe assets such as USDC, USDT, DI and BUSD. You can get pretty good returns. 1. Stable currency lending on platforms such as IVE and Compound, 6-8% annual yield. 2. Pledge, 4-20% annual rate of return. 3. Liquidity mining, 50-200% annual rate of return. 4. Return rate of Degan Flushing Earth Mine, 200-30% annual rate of return. Obviously, risks and returns are also positively correlated in the crypto market. For example, lending your stablecoins to relatively secure protocols such as IVE and Compound, they can give you at least 4% of annual revenue. The rate of return on borrowing comes from the borrower borrowing funds from the agreement and paying higher interest. The agreement makes the spread between lending and borrowing similar to what banks do today. If the demand for borrowing rises, so will the rate of return on borrowing. And the rate of return between different stablecoins will also be different. For example, the yield of USDT tends to be relatively high, because USDT, which is surrounded by various regulatory and shady problems, has caused many investors to avoid it. Therefore, it is only natural that 1 point of risk can be exchanged for 1 point of income. There are 2 main risks involved in this type of investment. 1. The agreement became the target of hacker attacks. 2. Insufficient collateral. This may cause investors to lose their capital. Cream finance, which has been attacked one after another, is a good example. Cream Finance's liquidity pool was eventually completely emptied, and users of the product became victims. Liquidity mining. Becoming a lender is not the only way to earn DeFi dividends. You can also choose to earn income by providing liquidity in a liquidity pool, that is, Liquidity mining. This means that you can collect transaction fees as a market maker, and sometimes you can also collect transaction fees as a reward in the form of governance tokens. But providing liquidity is not without risk. First of all, as a liquidity provider, you must hold at least 2 currencies, which means that you have at least 2 cryptocurrency exposures. Second, you may face a permanent loss. In this case, holding tokens is a better choice. Investors involved in liquidity mining also need leverage. For example, borrowing stablecoins at an annual interest rate of 10%, and then using the borrowed money to flush a pool of 30% of annual income, which creates a perfect arbitrage opportunity. While earning 20% arbitrage space, it can also obtain the risk exposure income of the original mortgage tokens. As long as there is such an arbitrage opportunity, there will always be a demand for high-interest loans in the market. This is the principle that the relationship between supply and demand creates high returns. Since many new agreements currently offer 30%-50% or even higher annual interest rates to attract liquidity providers, this usually raises the currency price again.